In the world of trading, especially here in the US, there's a belief that has trapped countless beginners. The idea that more trades equal more money. Think about it. If you're taking 15 or 20 trades in a single session, you assume that even if you win half of them, you'll still end up with profit. On paper, it sounds like a winning formula, but the reality is very different. Every trade you enter isn't free. You're paying commissions, exchange fees, SEC fees, and you're losing cents on every slippage. These small cuts might look harmless in one or two trades, but after dozens of trades, they add up to hundreds of dollars. Suddenly, the extra profit you thought you were making has already been eaten away before you even close your position. But that's just the financial side. Let's talk about the mental toll. Trading isn't like flipping a coin. It's decision-making under pressure. Every extra trade you take forces your brain to analyze more charts, predict more outcomes, and manage more emotions. By your 10th trade of the day, you're not the same focused trader you were on the first one. Fatigue kicks in, your judgment slips, and instead of following your plan, you start reacting to the market. That's how overtrading traps people. Not because they're bad traders, but because they confuse activity with productivity. Here's the hard truth. Trading more doesn't guarantee earning more. In fact, it often guarantees the opposite. Some of the most consistent US traders, whether in stocks, options, or futures, don't chase 20 trades a day. They might take just one or two trades, but those trades are backed with research, patience, and discipline. And when they win big enough to cover their losses and fees without burning out their mind or account. So in this video, we're going to uncover the real difference between trading more versus trading smart. We'll look at real-world examples, break down the hidden costs, and show you why sometimes less is actually more in trading. Let's think about what really happens when a trader in the US starts taking trade after trade. Imagine someone sitting in front of their screen watching the S&P 500 or NASDAQ. The market makes a small move and they jump in, close it quickly, and feel a small win. Just a few minutes later, they see another tiny move and enter again. By the end of the day, they've taken 15 or even 20 trades. On the surface, it looks like they've been highly productive, active all day, catching every opportunity. But when they finally check their account statement, reality hits hard. Every single one of those trades came with a hidden cost. First, there's the commission, maybe just a couple of dollars per trade, but multiplied by 20 trades, it becomes a serious dent. Then there's the bid-ask spread, the small difference between what you pay and what you actually get. And don't forget slippage. The price you thought you were entering at is rarely the price you actually get, especially in fast-moving markets. Put all of this together and hundreds of dollars quietly disappear from the account, not because the market was against them, but because of the sheer volume of trades. It's like trying to fill a bucket of water with a hole at the bottom. The more you pour in, the more leaks out. And the financial cost is only one part of the story. There's also the psychological wear and tear. The more you trade, the more emotional swings you put yourself through. A small win in the morning can make you overconfident, and then one quick loss in the afternoon can trigger frustration. That frustration pushes you to take another trade to make it back. And before you realize it, you're no longer following a strategy. You're chasing the market. It's like gambling, where each hand feels like the chance to recover, but in reality, you're digging a deeper hole. This is why many traders in the US fail. Not because they never had a good setup, because they couldn't stop themselves from overtrading. Their accounts don't collapse in one giant loss. Instead, they bleed slowly through unnecessary trades, fees, and impulsive decisions. And the saddest part is that it often feels like hard work. The trader believes they're grinding, hustling, and putting in hours, but the truth is trading doesn't reward activity. It rewards precision. The market only pays when your trades are accurate, not when you take more of them. Now let's look at the other side of the picture, the trader who doesn't fall into the trap of constant activity. Instead of chasing every little move, this trader waits. Maybe they watch the market for an entire morning and don't place a single trade. To an outsider, it might look like they're wasting time, but in reality, they're filtering noise and protecting their capital. When a clear, high probability setup finally appears, like a strong breakout confirmed by volume or a bounce from a well-tested support level, they enter with confidence. They aren't guessing, they're executing a plan. Because they take fewer trades, the hidden costs that eat up so many accounts, commissions, spreads, slippage, barely touch them. If they trade only 2 or 3 times a day, their account isn't being drained by fees. More importantly, their mind is fresher. They're not mentally exhausted from juggling 20 impulsive entries and exits. Each decision they make comes from a calm, focused place. And when they win, they usually win bigger because they've allowed themselves to be patient enough to hold on to the move instead of exiting out of fear. Real examples of this can be seen in traders who specialize in just 1 or 2 markets. Say, a futures trader who only looks at E-mini contracts, or an options trader who only trades setups around earnings season. These traders aren't in a rush to act all the time. They understand that trading is like fishing. You don't throw your line into the water 100 times just to feel busy. You wait patiently, you observe, and when the right moment comes, you strike once with precision. And here's the surprising part. Over time, this approach often makes just as much money, if not more, than the hyperactive trader. Not because they got luckier, but because they protected themselves from unnecessary losses and let their accuracy compound. Instead of dozens of average trades, they're stacking a smaller number of high-quality trades that steadily grow their account and preserve their mental health. When we put these 2 trading styles side by side, the contrast couldn't be stronger. The overtrader is glued to the screen all day, constantly clicking buy and sell, feeling like they're doing something productive. But in reality, each extra trade is quietly eating away at their profits through commissions, spreads, and slippage. By the end of the day, their account looks tired, and so do they. Even if they manage to close the day green, the emotional roller coaster leaves them drained, stressed, and more likely to make mistakes tomorrow. It's not sustainable. Now look at the disciplined trader. This person might take only 2 trades in the entire session, or sometimes none at all. To an outsider, it seems like they're wasting time, but what they're really doing is saving money, saving mental energy, and waiting for the market to give them a clean signal. When that perfect setup finally comes, they act decisively. And because they've been patient, they're not afraid to let the trade play out, often capturing a larger move with less stress. They're not fighting the market, they're aligning with it. Over weeks and months, that calm, selective approach builds consistency. Their account grows steadily without the constant up and down swings that overtraders face. The important truth is this: trading success isn't about activity, it's about discipline. The market doesn't care how many hours you sit in front of your screen or how many trades you place. It only rewards the quality of your decisions. That's why some of the best traders in the US aren't the ones trading 50 times a day. They're the ones who pick their spots, manage their risk, and walk away when the opportunity isn't there. They treat trading like a business, not like a casino. So the next time you sit down at your desk, ask yourself a simple question. Am I trading because the market has given me a real signal? Or am I trading just to feel active? If it's the second, you're falling into the trap. If it's the first, you're on the path to becoming consistent. Remember, you don't need to trade more. You need to trade smarter. That's the real edge in this game. If this perspective helped you see trading in a new light, make sure to hit the like button, subscribe to Profit Pulse for more trading insights, and share your own experiences in the comments below. Your support helps us keep bringing real, no-nonsense lessons from the market straight to you.